Okay, it's less about the symbol and more about the psychology that is dominating that time frame. That's what Dow theory did for me. And from that understanding of the different phases of the market, up and down trends, accumulation, distribution, I realized I'm going to need a strategy to handle narrow sideways markets. I'm going to need a strategy to handle, sorry, I'm getting over a cold, to handle a wider ranging sideways market. I'm going to need a strategy to handle uptrends and downtrends and reversals of those trends. So it's less about necessarily accumulating all these strategies and then just throwing them like spaghetti at a wall, and more about looking at your strategy and categorizing it into which one of these market phases they are the most suited to handle. Does that make sense to everybody? You match your strategy to the market. You don't impose your will on the market. Unless you are writing checks and the bank bounces, you cannot, and even then, you cannot impose your will on the strategy, your will on the market, regardless of the strategy. Even if you're a central bank and you can print money till you run out of ink, they can't even impose their will on the market, right? Exactly. The market's the boss. So everything starts from Dow theory and understanding those market trends. How do I define the market trend? Okay. So if you haven't got a pen and paper out yet, now might be a good time, because I'm going to start, we're coming into, now that you know, we spent a little bit here discussing the overall philosophy. And I know a lot of people just kind of glaze over during this point. Bad idea, because that is what I've just explained to you is the rationale behind why I do what I do. And unless you understand the why, the first time you start to get confused or have doubts, you won't have the foundation to rely on to say, okay, am I really working within the confines of my main goal here, which is to identify the market trend and therefore, after that, apply the appropriate strategy according to the message of the market. That's what it's all about. How do you identify the message of the market? That's what we want to discuss at this point. How do you identify the message of the market? The message of the market is the market trend. Now, each time frame might have a different message. In other words, it might have a slightly different trend. Okay? We're going to get into that when I discuss triage, but the first thing I want you to do is understand, and this is basic stuff here, gang, but the basics are what your success is built upon. You notice that I've got a daily chart of the dollar index here in front of me, and I did mention how important futures are to me. I'll look at the dollar. We had crude oil up earlier. I'll look at the Dow Jones Industrial Average. I'll look at the continuous commodity index. I trade Dow futures, the YM contract. I have some trades going on in the ES contract, the S&P 500. So these are charts that are throwbacks to my roots as a futures trader, but they all have a lot of implication in terms of what's happening in Forex. Very important, because the Dow, the dollar, crude oil, commodities, you can throw gold in there too, but not as much as it used to be. You can throw copper in there. There's been a lot of talk about WTI and crude because of the contango. I don't want to get too far off my topic. Some of this stuff we'll discuss in the second half. But these are all ways to gauge risk. Gang, what we are doing every morning as Forex traders, the first question on your mind should be, is risk on or off? Is there risk appetite out there? Are traders and investors' stomachs grumbling from some risk? Or are they just stepping away from the table? Risk aversion. That is the first question. How do I answer that question? I look at the dollar. I look at the Dow. I look at the trends. Now, just as I would look at the market trends, market phases on my Forex, I do the same thing on these charts, because one, I trade them, and two, they're going to give me insight into what's happening in the Forex market on that bigger picture. And that's going to allow me to better trade the pairs that I trade. So let's get into specific time frames here. You notice that I've been looking at the daily time frames, or if you didn't notice, these are daily time frames. And let's jump on over to some Forex charts. So I'm looking at some daily time frames here. And the reason I want to start with the daily, and we're going to go through all the time frames that I look at and how I look at them, but the reason I start with the daily is to be able to identify what I call the directional bias of the market. The directional bias. I think the daily time frame is the most psychologically significant and reflects the overall dominant psychology of the market. That doesn't mean that I'm trading it necessarily. It means that I'm using it as a gauge to understand the mood of the market. And actually, one of the things that I was looking at, and I wrote about it yesterday over at the Daily Forex Trading Edge, which is a blog that I write for the folks at Interbank FX. And I'm trying to remember the pattern that I'd drawn in. I believe it was in a rising, there we go, there it is. It's a rising wedge. Now, I wrote about this particular pair. But the reason I want to start with the daily time frame is to get a gauge of what the directional bias is, which is there a dominant bullish or bearish psychology on the daily chart? Think about this for a moment here, gang. If there is a dominant psychology in the market, I don't care if it's equities, futures, or Forex, if there's a dominant psychology, when prices start to sell off, people will be more willing to step in and support certain price levels in the bigger picture. So in an uptrend, people will tend to look for opportunities to be a buyer. And in a downtrend, even a great up day will often be shorted into. So you have to understand that dominant psychology, because it'll give you an idea of what people will tend to do depending upon price action. The directional bias for me also sheds light on which time frames I will focus on. So when I have a non-trending directional bias, like I do here on the dollar Canada, which I define it as non-trending because take a look at the angle of the wave. It's moving sideways. By the way, for those of you who don't know what the wave is, it's the 34-period EMA on the high, the low, the close. Those these dashed lines you see going across my chart. The other lines on my chart here are the 20-period simple and the 200-period simple. The candle colors you see here are a little different than your traditional Japanese candlesticks, because I kind of call these candlesticks plus. They're grab candles, green, red, and blue. And in addition to my 34 EMA wave, in addition to my 20-period simple on the close and my 200-period simple on the close, these grab candles are ways, a tool in which I can determine the way in which prices are moving in a bullish or bearish manner. The way they plot is if we close above the 34 EMA high, the candles plot green. If they close below the 34 EMA low, they plot red. And if they close within those two lines, it plots blue or neutral.